Okay, happy snow day. These are videos to review the homework that we had, our first homework in chapter 7 on inventory measurement. The first problem is a periodic inventory system, the second problem being a perpetual inventory system, the third about when you record shipments based on their terms. And then the last one, problem 8.1, really compares that periodic system and the perpetual systems in how they record stuff. So remember that the periodic system does not record transactions as they happen, but rather at the end of the period, we use our inventory formula to calculate our inventory and figure out our cost of goods sold. So here is our first problem, again, this one being a periodic system. So it doesn't record the purchases and sales as they go along, but rather at the end, we determine the inventory based on that inventory formula. And what is that inventory formula? You take the beginning inventory, you add purchases, you subtract cost of goods sold, and that gives you your ending inventory. So the question here was to determine the amount of ending inventory. They give you that the beginning inventory is 186,000. Our purchases were 945,000. Our cost of goods sold was 982,000. And so we can figure out our ending inventory using that formula, add our purchases, subtract our cost of goods sold, and our ending inventory is 149,000. So that is our periodic inventory problem. Brief exercise 2 was now a perpetual system, and they asked you to record the journal entries that would be posted using that perpetual system. So we have the given information on here is beginning inventory is 267,000. It says that purchases are 845,000. That cost of goods sold of 902,000 and sales 1.42. So we are going to use that information in our problem to book our journal entries. So what is the first thing that we do? We record the purchases of inventory. So we increase our inventory, because again, we're going to perpetually record inventory as we purchase it. So inventory, we increase by 845,000. So that is a debit to inventory, 845,000. And the other side is that we have to pay for that. We owe our vendors 845,000. So that is a credit to accounts payable, 845,000. That is their first journal entry to record our purchases. Then we have to record our sales. So we have accounts receivable from our customers. They are going to pay us. And that is for the full 1.42. That is our selling price on those items. So we increase our accounts receivable 1.42, and that books to sales revenue. That is the other side, our credit sales revenue. We record those sales. We also have to adjust the cost of goods sold for those sales. So we record cost of goods sold. That is at cost, 902,000. And we decrease our inventory. Again, we are perpetually changing our inventory based on our purchases and sales. So these are our journal entries to record our sales, our purchases, and both parts of the sale, the amount that we're going to receive from our customers, as well as the amount that it cost us to create that inventory. Okay. Brief exercise 3 was about when you record inventory. So we have a couple of different transactions. All right, so we shipped some goods, FOB destination, on December 29th, 2016. and they arrived in January. We also shipped goods in. So this is outgoing. To a customer. And we also have some incoming to us. And that was shipped FOB shipping point. And they were shipped on December 30th. And they also arrived in January. So they want us to note which ones would we include in our company's inventory. So these outgoing ones to customer, we say that changes hands at destination. So when they are received by the customer, we record them as being sold. Well, they didn't arrive at the customer until January, so we should, yes, include that in our inventory. The incoming shipments were shipped FOB shipping point, meaning that they change hands when they are shipped. They were shipped on December 30th. Even if we didn't get them yet, we took title to those. So yes, we should include those in our inventory. So both of these items should be included in Kelly Corporation's inventory based on where they took title or where they changed hands. Okay. Our last problem 1, is a comparison of the transactions with a periodic versus a perpetual inventory system. All right, and there's a couple of complications here. So we have beginning inventory. We're just going to note the information here that we have. Beginning inventory, they tell us, is 15,000. Okay. And our we have company purchases of 22,000, and this was on October 12th, 16. Make this bigger. Let me just make everything size 14 so you can see it nice and big. Okay. So our purchases, 22,000, those were purchased on 10/12, and we have some terms. We use the net method. So you remember that from the last chapter, we use the net method. The terms are 210 net 30. So if we pay them within 10 days, we get a 2% discount. And if we pay it within 30 days, we just have to pay the full amount. Okay. We also had some, we should also note that this was FOB shipping point. So that we record that when they are shipped. And we have freight charges of $500, and those are paid in cash. Okay. We have that on October 3rd, those were paid. October 3rd, sorry, I gotta fix this. Here we go. On October 3rd, 31st, we paid for the merchandise that was on Part A. So on 10/31, we paid for our purchases. Then during October, our sales, 28,000, and our cost of sales was 18,000. So again, I'm just writing down all the information that's given in the problem. And then last, our inventory ending, it tells us in Part C, or D actually, is 19,060. Sorry, this didn't copy and paste very nicely from the book. Okay, so Part 1, let's do this on the perpetual system. Oh, sorry, first part one's periodic. Okay. Let's do our journal entries for the periodic system. So we have to record our purchases that were on 10/12. So our first entry on 10/12/16, we have purchases, and we are going to record that net method, meaning we are going to assume that we are going to take the discount. So we take our 22,000 of purchases and we multiply that by 98% to take the discount. So that is 21,560. The other side of that is that we have to pay for it, so we hit accounts payable. So again, this is our periodic system. We are booking our purchases during the year to purchases rather than capitalizing them into inventory. So we are booking our entry on 10/12. We record our purchases. We also have to record this freight. So we record freight, that just goes to a freight in account, $500, and accounts, we paid for that in cash. So that's another $500 right there. That reduces our cash. We then have to pay for those on 10/31. We pay for our purchases. So accounts payable gets reduced for the amount that we recorded of the payable. Now, 10/31, I paid for them. Did I pay them for them within 10 days? No, I didn't. So I have to pay an interest expense when I don't take that discount. So the amount of that is the 2%, or if you just subtract that from the purchases, the difference here, $440. This is also 2% of the 22,000. And we pay in cash the full amount of the purchase. We don't get the discount. We pay $22,000. Okay. The last entry that we have to make is our sales. So we have the next piece of it is to record our sales. October 31st. We record accounts receivable. Our amount that our customers are going to pay us, $28,000, and record our sales revenue, also $28,000. Okay. No entry is made for cost of goods sold. Why? Because this is under a periodic system. At the end of the year, we are going to book our cost of goods sold by using that cost of goods sold formula. I'm going to get cut off by YouTube for going over 15 minutes, so I'm going to stop here and I will finish this part in one more video. Okay, thank you.